Nifty, Sensex, mid-cap, small-cap indices, all of them are off to a good start. The collateral damage of yesterday, well, a lot of that has got erased already. In terms of mood, if there was a scare on street yesterday, today there is relief. Is it time to now breathe a sigh of relief, or the volatility is back in global markets and it's going to haunt us? Let's take that conversation forward with Ajay Srivastava. Ajay, a crazy Monday. Are we in for now more volatility, or the storm has come and gone?
Well, Nikunj, unfortunately, I can't say the storms have come and gone, because the storms is what brings in the fresh air in the market, and storm is what cleans out the deadwood from the market. I think it's a great thing to have corrections, because two things happen. One is the complacency in the system disappears, that everything is going to go up and you need to plan your portfolio. You never need to book profits. You never need to look at your stock at all. I think that complacency is now gets a one root check. Now, listen, guys, you need to look at a portfolio. Making money is not all that easy in the market. You need to select stocks, be with them, add, and when time has come, to sell the stock as well. It's not necessary to just keep adding up the stocks. So I think we will see more volatility, for the simple reason that we are in India, we are at a much more bigger crossroad, that, while there is a clamor for interest rates to go down, you've seen what happened to the bank. The ability to find money is very, very becoming difficult for them. So we are, unlike in the US, a different conundrum altogether, that there is scarcity of money with the bank, while there is pressure on interest to go down, and which forces a saver, if interest goes down, go toward more towards equity market, not less. So yes, volatility will continue. I think new themes will emerge in the market, but the key factor is booking of profits is again coming back to the table. Did you manage to book some of your profits when the going was good in momentum stock? You may get the same price back, but that will take a lot of time for some of the shares to recover.
List of avoid includes insurance and online companies. Now, insurance has just about started coming back. Online companies have made a comeback with the exception of Paytm. Let's talk about these two sectors. Why are they on your avoid list?
I think three things. One is we are so underpenetrated in India on insurance that it is ridiculous compared to any standard in the global. That's one. Number two, the regulatory environment is so beautifully structured that you don't see any new insurance companies coming up, and so that's a life insurance. Now, some of the banks which have got insurance companies have a ready-made customer market who they go and sell their products to. So unless something dramatic happens in the regulatory scenario, that's one. Number two, the biggest meltdown which has to happen with all the ULIP policies is already past us. Now these are genuinely good policies which give good income to the most of the companies. Third is that interest rates go down, their portfolios of gilt will appreciate in quantitatively, and their bonuses and the performance will improve. I think it's a market which is ever expanding. Competition is very limited in life insurance, and income is almost guaranteed in a manner of speaking. And with less dependence on ULIPs, volatility is less. All four tell us it's a great place to be at this point of time. Same goes for general insurance. If the PSU insurance companies walk out of general insurance market, can you imagine how much is opened up for both health and general for the private sector? So both these sectors, I think, are just tremendous opportunities, safer opportunities. They may not give you 10 baggers, but I think they are certainly compoundable at 20-25% return if that's what you're happy with. And I think you should be happy with that. Clean, comfortable sector and very under-owned. That's the best part. Not many people own it. So by the time the trade happens, like you saw in defense, when people start to come in, the real expansion of multiple will happen. It's very nicely positioned, nicely structured, good valuations, under-owned in the market. It's a very sweet spot.
Okay. So Ajay, if insurance is safe, what's looking unsafe right now?
As always, you have a risk on the PSU. As always, you see the OMC stock, highest riskiest. I think that's the real gamble. If you ask me, if you need to gamble, don't worry about option. You got to gamble and say which trend is what's going to happen to the OMC in the next quarter. I think PSU stocks, to by and large, is going to have a bigger problem. And number two is the chemical stocks. Overpriced to a point which I don't understand how they're priced in terms of PE multiple and the growth. So two sectors very clearly. I'd like to add defense, but I would just say the scarcity of stock. Unless government sells a stock big time, there is no liquid floating stock in the market at this point of time. So I would have put defense in that category, but only because the floating stock is so little, and everybody who sits on it doesn't want to sell, which means that volatility is so much less in those stocks. Prices may correct, but at every correction you want new buyers. So I haven't added there, but I would simply say that I think, to my mind, chemicals is one place where it's overinvested. over multiples are being paid for a very mediocre kind of a growth scenario.
Let's go back to the global picture. This yen carry trade, it scared the wits out of everybody yesterday. And today looks like it's history. So can a large carry trade impact just last for 24 hours? I'm just trying to understand that what is the right way of understanding that how much of unwinding is over, how much is left, will it continue?
You can see it always happens that the leverage positions actually create volatility in the market. And leverage, when it gets cut, there is no way to retrieve it because you're not able to borrow more. Even just any option trader would understand in India as well that when the time comes and the margin is called and you're not able to pay up, the system automatically chops them off and sells the positions. And all these traders, global hedge fund that we have seen, they don't hesitate to cut their trades. I think that's compared to what we see in India and our mentality to see wait it out. There it is cut and burn. It's either go all in or it's a mentality. It's nothing to do with the fundamental or should you have waited, not waited. That's the way they always work in life. That listen, if an event has happened, we need to just exit. Exit means exit. And we've seen it happening so many decades now that these people uncaringly cut the position because for them, booking that profit is more critical than the future anticipated gains. They run from year to year, their bonuses and their profitability and their reporting to investors. So, unlike most of the other investors, these funds are literally dependent year to year on showing up performance and more important, liquidity. There's no way they can put in liquidity. If I have a problem, I can just take my fixed deposit and put in the money as a margin. They don't have the liquidity. So they have no choice, Nikunj, but to cut. Answer is this will continue. It has happened many times. I don't think so. We have seen the end of it. What we have now seen, assurance in the market that yesterday all the right noises were again made by the central bank saying, we're not going to let the equities sink. So we are back to the same game. Market will do the thing. Central bank will come and says, guys, don't worry, keep investing. We will look after your interest. We are back to the races.
Somebody is watching the show. Can I say that, look, what we saw yesterday in terms of the global market sell-off, that's history now, time to move on. Look at what is in India rather than getting worried about Fed, Japan, Bitcoin, gold.
I sometimes tell my people that knowing a lot is a lot worse than knowing less at this point of time. If I look at all the risk in the world, I'll never invest money at the end of the day. I might as well not just put in a gilt fund and be done with it or whatever it is. No, things can happen. I think we are looking at volatile times in the US. But what we have seen so far is that Indian economy being so insulated, okay, at this point of time in terms of export, imports, connection, global, etc. I think we have been able to weather it a lot better and will become better and better because FI holding is now lower than domestic holding in the market. Their stay is lower. Most of the Ps we know of are exiting their position in India. If you look at net, you'll be horrified at the kind of exit we are seeing versus the entry into India of PE fund globally. And globally, PE funds liquidity is also down at this point of time. So, matter of fact is, people sitting abroad with money from abroad have lesser and lesser role to play in Indian equity markets. Good in a way, bad in a way, whatever you want to call it. Fact is, today they can't influence the way it happened in the past. It's going to become much less in the future. And as I said, every month, no matter what happens, your money which goes to the PF, 15% of that has to go to the ETF. Market can be 500 point down, 5,000 point up, or 2,000 down. ETF money will go into the PF money will go to the ETF no matter what happens. Now that's a big stable platform of buyer in the market, irrespective of global conditions. So we have stable, good. Focus on what you missed out. Why are you focusing on going down? Every time I meet people on the flight, they say, oh, you know what? I missed out. Guys, you missed out. You had a chance to get in again. Don't blame the market saying, don't give me a chance. It gives you a chance all the time. 4th June, it gave you a lovely chance. Yesterday, it gave you a beautiful chance. Don't ever say, I missed out.
That brings me to my next point. Now, what we were debating internally yesterday, and perhaps we spoke about it also, was that, look, 4th of June, you got a great chance, but that was a local event. You got another chance on 23rd of July. That was on the budget day. But yesterday, it was a global factor. I mean, does it make sense to buy the decline? Because unlike the June event or the July event, which were local in nature, this is a global event. Should that basic strategy be still to buy on a bad day?
I think it should be. See, what is the event? The event is whether you can call it recession fears in the US, whether you can call it carry trade, whether you can call it suddenly the interest rate pressure coming on there. There are a number of factors which went in. Can't be one factor. That's one. The number two is, if your stock picking is fundamentally good at this point of time, let's take what happens to an airline. It did announce, let's say, I'm not saying buy it, but it announced that I'm going to do business class fare. They do a good job in what they do. Nothing happens to that company. They're doing a good job day in and day out, and Indians are expanding, traveling, etc., etc. Now, yes, some volatility, some pricing multiple may correct itself over a period of time given the global volatility. What will happen with good companies, perhaps, is the multiples may correct. You might have entered a little wrongly, but then if you've got the wherewithal, you can keep averaging down. But your ability to enter good stocks comes on such days. Lots of stock you were actually, it's an amazing market. You could buy the same stock on a filter day for yesterday, or on a lower filter yesterday, and you were not a buyer there. Now that tells you that that you can't dictate with the market. You got to go with the stock that you want to buy, and if you were willing to buy it 24 hours back at a circuit filter, you must be convinced enough to buy it next morning at a lower circuit filter, or you are just doing gambling in the market, not investing. Investors would not hesitate to buy a stock, a good quality stock, when a market presents its corrections. And markets can be whatever they can do, but you got a chance to buy the stock. Don't hesitate. These events will happen. Interest will go down, interest will go up, recession will happen, recession will go down. Good companies carry on. You look at the last 3 years, companies are given 3 to 4 times, large caps, 3 to 4 times returns to investors. It didn't happen because you didn't hold on to them. It didn't happen because you didn't add on correction. It happened because you responded to the company, not to the market. And I would still urge investors. Many will think will happen in the US. Let's see who becomes the president. What happens? Bangladesh had an upheaval just now. How many events can you factor into investment portfolio? You decide for yourself and create complexity. Or buy a good company and sell it at a good time, enjoy a good life. Because if you're not enjoying a good life, if you were tense for the margin yesterday, I think you're doing disservice to yourself in any market scenario. Were you happy yesterday? Did you enjoy the holidays? Do you have money in the bank to spend on your children? If you tick those boxes, international market don't matter. What matters is improvement in your life. And that's what market is all about. Improve your life, not maximize returns.
Okay, words of wisdom today from Ajay Srivastava. Good chatting with you, Ajay.
Thank you very much.
Thanks.
You have a good day.
Okay.